Are we in a market bubble? This is something that the press is talking about every single day. It is a rational and reasonable concern because the market has done so well in such a short period of time. So in this video, I want to share some historical perspective with respect to whether our markets are expensive or inexpensive, how some of those metrics are used and what they mean, and make sure you stick with me to the end because I'm going to give some perspectives as to how you can think about a combination or mixture of stocks and bonds in your investment portfolio can satisfy what I call your tummy tolerance, or making sure that you can sleep well at night, and also making sure that it can keep up with your retirement spending plan over multiple decades. These slides were put together by JP Morgan Asset Management, and the first slide we're going to take a look at is the S&P 500's performance going back to 1997. And the box in the middle is taking a look at other periods in time over that slice of time that we're looking at here, where the market had hit highs. And the first one we're looking at is right at the top of the technology bubble, and that is in March of 2000. And so the index level isn't as important as really what is talked about frequently in the press right now, which is the price to earnings ratio. And there's a number of ways of calculating this, but for the purposes of looking at what is here, what this is saying is that in year 2000, an investor was willing to pay $25.20 for $1 of expected future earnings 1 year in the future. And what that simply means is to get $1, you got to pay $25.20. That's a very high expectation, which means if there's any threat to the ability of being able to recoup that type of investment, things could look very bad with respect to stocks, and they did. So starting in March of 2000, the technology bubble burst, and over that 2.5-year period, the S&P 500 lost almost half of its value. Now fast forward to September 30th of this year. Well, investors now are willing to pay $22.80 for every $1 of expected future earnings. Again, the expectations are very high, so even the slightest type of disappointment could end in a sell-off with respect to stocks. So this, when written in the press, or if you hear the price to earnings ratio or the multiple, that's another word that Wall Street uses, the multiple for the market is 22.8. All that simply means is that an investor is paying a relatively high amount of money for an expected dollar of future earnings, which means that it's pretty frothy at the top, and any kind of negative event could result in a sell-off or a downdraft in the market. Now, the composition of the S&P 500 continually changes, and the reason for that is the S&P 500 is what's called a market cap weighted index. And that's just a fancy phrase by Wall Street to basically say that the largest companies, as valued by, if you took all of the shares outstanding and you summed up all of them, the companies that have the largest total value are the ones that represent the greatest portion of the index. And because they represent the greatest portion, they have the greatest weight. So their movements dictate the movement of the market. So if we look back 40 years ago to 1985, the largest companies in the S&P 500 at that point were IBM, Exxon, and GE. Those were the top three. Fast forward another 10 years. Well, IBM is still there, but they're toward the bottom of the pack at that point. GE, AT&T, they're still in there, but there's some other newcomers that are in the top 10 as well. Fast forward another 10 years. Well, IBM is on its way out as far as being one of the largest companies in the S&P 500, and GE, Exxon, and even some of these newer types of names like Microsoft are in there as well. The point is, as you look through each of these 10-year periods, all the way into what we are at today, where you see the Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, Tesla, and even Broadcom, those are the heaviest stocks in the S&P 500 today. Their movement is going to determine and has determined a large portion of the S&P 500's performance, especially over the last several years. And this is what's getting Wall Street and also investors concerned, because if you own just the S&P 500 or a growth fund or ETF, by and large, your composition of stocks is going to look very similar to that. So as these names go, so does the performance of your portfolio. A practical way to be able to address the concern about, well, are we at a market top? Is what I have inside the stock portion of my portfolio in jeopardy or not? The truth of the matter is that anything that you have in the stock side of your portfolio is always in jeopardy at any time. There's never any degree of 100% certainty, as much as Wall Street and the press wants to say there's a heightened level of uncertainty or greater uncertainty or more certainty. There isn't such thing as certainty with respect to stocks. If there was, there wouldn't be the opportunity to get the kinds of returns that stocks offer. The point I'm making here is, with this very busy chart, which I call the periodic table of stock and bond market areas, this is taking a look at, from 2010 to year to date, September 30th of 2025, the various aspects of the market and their returns. So for this year, the three top boxes, this purple one, EM equity, emerging markets equity. So those are foreign emerging economies. Those have done, by and large, the best this year. Next is developed market, which is international, primarily developed Western Europe. That has done well, followed by US-based markets. Now, what is the top versus what is the bottom? That's anybody's guess. And that's all it is a guess. Trying to determine what's going to happen in the future. Wall Street has great stories, tools, methods. It all sounds fantastic. But I'll tell you right now, none of those experts know what's going to happen with any degree of certainty as to what is going to be top versus bottom. So what do? You just take a look at owning all of it. So these white boxes here where it says asset allocation, this is a hypothetical portfolio of 60% diversified stocks. So everything on this periodic table that invests in stocks, it owns in a certain proportion that makes up that 60%. The others, which is bonds, fixed income, high yield bonds, those are in another configuration. That represents the 40%. And the assumption is that it'll stay at that mixture of 60-40 consistently over the period of time. And what you see here is the peaks and valleys are closer to one another in this type of scenario. So diversification, as boring and as uncomplicated as it possibly can be, is one of the biggest attributes of being able to navigate tough times when it comes to market movements. So irrespective of whether we're at a market top or a market bottom, deciding what type of mixture is going to make most sense to have you sleep well at night and also cover your retirement spending needs is critical. So in this case, trying not to guess as to what's going to do best versus worst, or should I get out of things entirely, just make sure that you own a certain proportion of each of them and make sure that it's consistently rebalanced. The other aspect is time in the market. Now, I fully recognize the older each of us gets, the shorter our time horizon becomes. And so that's not lost on me. But what we're looking at here is that all bets are off in the short term because the green is stocks, blue is bonds, and the gray is a 60-40 mixture of stocks and bonds. So looking at and comparing and contrasting, stocks are volatile. In a one-year period of time, over the period of 1950 all the way to 2024, stocks could be as high as 52%, but they could also be as low as 37%. A diversified portfolio like the 60-40 could be up as much as 34%, but down as much as 20%. And even bonds could lose money. We all figured that out in year 2022 when rates went up. Bonds could lose 13% in any one-year period over the time period that's been included here. However, the more time you have with respect to your portfolio, the more those returns tend to smooth out. So it's not lost on me. As you head into retirement, you have less and less years of retirement. Any kind of short-term knock could offer an opportunity to really kind of throw you off your spending pattern with respect to your retirement plan. That's why having a diversified portfolio and a mixture that's going to make you sleep well at night is important to examine. So over a rolling 5-year period of time, very different types of negative results. Stocks lost 2%. Bonds lost 2%. A diversified portfolio over any rolling 5-year period from 1950 to 2024 didn't lose anything. And that only improves as it goes to a 10-year and to a 20-year. The point here is that your mixture of stocks and bonds and then being able to segregate it inside your portfolio for the things that are longer term. What do I mean by longer term? 5 or more years where you don't have to touch those. Because what we saw on these other charts, the technology bubble burst, that was a 2.5-year period of time, which was a relatively long period of time, at least historically, with respect to the market moving down. That's not to say that it can't happen again, but typically when we're taking a look at downturns, they last about a little over a year. It takes a little bit more to recover, but by and large, over 80% of the movement in the stock market is positive. It's just the negative movements tend to be very scary, very rapid, and very dramatic in a lot of cases. But if you have time, diversification, you can smooth out and round out those peaks and valleys as far as your performance experience is concerned. The last thing I'll share here is something that I see on a fairly frequent basis, and it's called drift. And what I mean by drift is, and it's being illustrated here. If somebody started with a 60-40 stock to bond portfolio back in January of 2019, if they did nothing and just let that portfolio go, in September 30th of 2025, they would have 75% in stocks and 25% in bonds. That is an entirely different type of risk profile, and it presents entirely different types of positive or negative types of results. This happens more often than I think most people realize, because by and large, if you're just kind of wanting to get yourself into a portfolio, set it and forget it type of scenario, maybe you look at it a couple times a year. Okay, market's done well, things are going higher. Look at it another 3 to 6 months. Without rebalancing it, you are unwittingly kind of moving the risk profile in a different direction. Now, this could flip on its end too. If the market didn't do well from 2019 to current and the stock side had shrunk, let's say we go back to the technology bubble bursting. That is the inverse of this. So instead of bonds being 25% of the portfolio, they could be as much as 50 to 60% of the portfolio. So at the bottom, when the market bottoms out, there isn't enough stock exposure inside the portfolio to really benefit from that inevitable move forward, which nobody's going to know when that bottom exactly is until long after it's been experienced. So making sure that there is a periodic rebalancing exercise done inside the portfolio to get it back to that original mixture of stocks and bonds that's going to give you the best opportunity to be able to stick with that plan emotionally and also keep up with your spending plan over the course of your retirement years. So hopefully you found this information helpful and has answered some questions that maybe you had with respect to what to do in the midst of a market top.